And I think this is going to be met with heaviness as the NASDAQ rallies back up to the opening gap range. I'm sorry, opening range gap high, which is this, again, this level here. And that is the previous settlement price on regular trading hours. Okay. When you have that, wherever we stop trading using regular trading hours, you want to have a line segment. Like I use this one down here. See over here, horizontal ray. Wherever we stop trading using the regular trading hours, as soon as it does that, easiest thing you can do is immediately toggle it right there, drop it on your chart, and label it, opening range gap settlement. And you adjust it where this would show high. You just want to have this initially. Okay, this is how I teach my son, and that way this. If I'm teaching it him this way, it's good enough for you too. Okay, and what will happen is you're watching price ahead of 9:30. So around 9 o'clock, 9:15, you start paying attention to it. And are we above or below that previous day's settlement price? Using regular trading hours, okay, on TradingView. But the settlement price label here, you would change it to if the price between 9:15 and 9 o'clock is, if the real-time price is above that settlement price, then you would label it the low. If the real-time price between 9 o'clock and 15 minutes after 9, before the opening bell, New York local time, everything I'm talking about time-wise is always New York local time. Okay, so East Coast time, Eastern time. If price at real time between 9 o'clock and 9:15 before the opening bell, New York local time, if it is below the settlement price, you would change that settlement label to high. Okay, real simple, right? Real easy. It's not technically complicated, but that's how I teach my son. That price, that previous settlement price, is going to many times be revisited, regardless of what the daily range does. It doesn't necessarily imply or mean that it needs to go back up there to go down. It doesn't mean that it can't go up there and keep going higher and not even revisit going back down as a support level. It just means that it's going to want to gravitate back to that, usually within the first 30 minutes. Not always. It's not a hard and fast rule where you can set your whole lifestyle around it. It's not cast in stone, basically. It's just a thing that I like to look for. The market's likely to do it, and how it does it. How does it perform that function? This morning I was referring to it because we had the SIBI here at 8:30, the sell side imbalance, buy side inefficiency. And because it had that on the 5-minute chart, and we're going to drop down to a 1 minute in a second, I felt very confident that we would see it draw back up into this. But once it gets into this area here and touches, it needs to touch the opening range gap high, which is that level here. Once it touches it, we can allow for the market trading just a little bit outside of that fair value gap, which we'll show specifically on the 1 minute chart, which is what you're seeing highlighted here. Okay. But I said, remember that we can see it trade outside of that fair value gap because we're in the early stages of what? The opening range. And 9:30 tends to be a little bit wild, and we can see a little bit of discrepancies that would otherwise, between 10 o'clock and 11 o'clock, there's far less likelihood of a mohawk forming. It can, but we really want to expect to form around a fair value gap that we're watching and stalking between 9:30 and 10 o'clock because there's a whole lot of orders coming in. Everything's being piped in that first 30 minutes. It's amateur hour. Everybody's trying to do whatever they think is supposedly the right thing for them to do because they're in a chat room, they're in some kind of signal service, and everybody wants to follow the leader. Okay. So because of that, it's going to create these errant price actions where it goes beyond the level of precision, but we allow for that, which is what I refer to as a mohawk. Okay.